Please remember that futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I author in my weekly written reports. Prices shown on charts and quote bars are in real time and take into account all known activity up to this point in time. If you'd like to read more of this disclaimer, simply hit the pause key on your computer screen. Traders, I'm Boyd Baker, and thanks for tuning in to another options tutorial. Today we're going to talk about a specific options strategy, and we're going to talk about the short strangle. This happens to be a neutral strategy, and in the terms of our options ladder, we talked about bullish strategies up here, and today we're going to cover the neutral strategies, specifically the short strangle. What do we mean by a short strangle? Typically, when you're establishing a short strangle, you are selling an out-of-the-money call and an out-of-the-money put. And they're different strike prices. When you're looking at the straddle, you'd be looking at the same strike prices. But with the strangle, you're selling an out-of-the-money call and an out-of-the-money put. I'll show you what that looks like in a chart in a little bit. What you're trying to do is collect worthwhile premiums on both sides. You want good value on the call, good values on the put. You want to be out of the money, but still being able to collect decent premium on both sides. You also want to be as delta neutral as possible. What do we mean by that? We talked about deltas. You want to see the call delta and the put delta be fairly close in value or equivalent. And it's best to try to establish this trade when volatility is high and you're looking for sideways action with maximum premium decay. What do we mean by that? Well, you want to be able to try to put this trade on when you have a market which is moving a lot and you want to see the market move in sideways action. Now, in the past, we talk about the crude oil market, and we say that crude oil is trading right now at about $50. I think it's just underneath that, about $49.50. Now, it's traded way up to $100 and made a big move down here to $45 and is starting to trade in more of a sideways pattern. Now, if you believe that it can continue to be trading in that $50 area, one might consider a delta neutral strategy such as a short strangle. In doing that, one can consider selling the $60 call and at the same time selling the $40 put. They're about equidistant from where the futures is trading right now. Those strike prices happen to be very liquid also. Now, when I came in this morning, the $60 call was trading at about $400. The put value was trading higher at $750. You combine those premiums, you're collecting $1,150. Now, in a perfect world, as you approach expiration, that's going to approach zero. You collect or can collect all $1,150, but that's not until option expiration. Let's say that you're wanting to put that trade on and it's a 90-day trade. Let's say halfway into the trade, the premiums have declined 50, 60%. That $1,150 that you collected is trading down to $500. You could always buy that back and you'd make the difference between $500 and $1,150 or the $650. Now, this is a two-option strategy. Remember, you're selling a call out of the money, selling a put out of the money. It's going to require margin. In this case, the crude oil margin is about $4,900. The margin on this is about two-thirds, about 60%. So it's going to take about $3,000 in order to put on this short strangle. If you have any questions on this, feel free to call me here at 866-973-2079.